Digible didn't have business insurance in the beginning because it can be costly. It's also time consuming to set up and yada yada. But at some point, we started bringing on clients where it was requirement of their vendor agreements that, hey, vendor, you must supply us with $2 million in liability coverage.
There's a million different reasons businesses don't make it, but I assure you there's plenty of that involves or could have de-risking that just are not even considered. And so from that standpoint, yeah, I might be more aggressive and expecting some level of higher return.
Welcome to the Digible Dudes podcast. I'm David.
I'm Reid.
Reid, I feel like we're a little out of sorts. I feel like a lot of the podcasts we've been doing haven't included intros recently, and or we've also just gotten off cadence. So I'm just
I think intros are overrated, but still necessary. So I'm not going as far as they are unnecessary. But I don't know how you feel. I think I can probably recite half of the Huberman Labs intro now. Of course, different topics, but there's kind of the same flavor.
Yeah.
And of course, the worst part of that podcast, which I also respect though, is the sponsors. We haven't gone there yet. And to be honest, I hope we never do. But that might also tell us that we're onto something if we're actually at a point where we can get sponsors. But yeah, I think it's okay to just dive right in. But
yeah, well, it's hard when you and I did a couple guest podcasts, meaning we were on someone else's podcast, and when they do their intro, I feel like I'm uncomfortable with how they beef us up. So I feel like I could start beefing you up with some of those intros that they use.
Maybe so.
Reid's impact on the world, blah blah blah.
Yeah.
So, anyways, I'm with you. But the other thing I thought was funny, I haven't ribbed you on it yet, but did you? I think you'll get the joke. But you know how when people are into CrossFit, they talk a lot about CrossFit, or if they're into vegan, they talk a lot about vegan.
Yeah,
that's
it's like religions for those people.
That's Huberman listeners.
Oh, you think so?
Anybody that listens to Huberman, it's just like the CrossFit people are the vegan people.
Yeah. Well, I think you're probably mostly right, but I've been surprised because I actually had a virtual coffee with Greta, who's won that label early as far as the most interesting employee at Digible. And often, when we're dropping references in books, podcasts, and stuff, she's the one employee that actually follows up and investigates, reads it. She checks the mark and times 10 on hashtag curiosity. And so we were having our coffee this morning, and she's like, I really appreciate some of your references to Huberman. I think it's a great podcast. And I was like, oh boy, I got another groupie here. And so I dove right in, and she's like, well, wait. Let me just qualify. I can't listen to the full 2 hours. And I was like, what? And she's like, yeah, I just kind of float in and out. And I was like, you're not a Huberman listener.
She's out of the club.
I didn't get offended, but I was like, and Miranda, my wife's the one who turned me on to it. And she's the same way. She's like, it's just way too much. I can't listen to a lecture every time I listen to a podcast. And so I think that there's, call it the passive Huberman listener and the active. And I would really be interested to see what that pie chart looks like. Do you think that the majority of his listeners are in fact not full bore, loyalist, purist, the way you're talking about cross training and vegan, etc., or would you venture that in fact overwhelmingly it is hardcore Huberman groupie? Sounds terrible, but
well, I think I do think you make a good point. There's also what it is not is appointment listening or viewing or something, right? It seems more of those types are like, oh yeah, when I'm interested in X topic, I will go there. Or maybe I'll do a search on his feed to see if he's talked about whatever water intake or something, right? So I could see they are evergreen content, but I could see it being more of okay, I'm going to refer to him as a resource when I have an interest in something. But maybe I'll watch the feed every week and see what comes through, but I may not tune in, right? That, because that's just not where your curiosity is about whatever health at that time. So I think there are definitely podcasts for me that have been okay, this comes out on Tuesday. I need to consume it on Tuesday. So it's more appointment
right.
And then, but then they can fall into a situation where if they stop really meeting, I guess, my needs or my interest just changes where it's like, oh, I'll skip this week's. And then if you start making that a habit, next thing you know, it's like, do I still need this in my feed every week?
Totally.
Like maybe I'll remove it.
Totally. Yeah. Well, thank God for Darren because I think he thinks about this stuff all day and all night
Hmm.
and is trying to help us better understand it so we don't also have to think about it too
Yeah,
much. But I wonder, like, the Nicole sent us, remember the ChatGPT, like, widget for Huberman? You remember
I don't
this?
remember. No.
I was so excited when she sent it, but then it was also like I felt like I was almost cheating on him, because it's like I'm not
Mm-hmm.
listening to your full like, I'm not being that
Hmm.
devoted listener.
Hmm.
I'm
Hmm.
just skipping to, you know,
Hmm.
this AI generative like
Hmm.
answers to some of these topics. And I wonder if that affected his listenership because we talked about this even with the summit coming up. It's like, should we do a live stream? Should we expose a lot of this content or should we stay more with this was walled up? It's create the FOMO and that's how you uh build the event. On some level you can make that comparison to podcast, right?
Hmm. Yeah, I do. Yeah, and I love that it's typically more for us evergreen, so that it doesn't have to be. It loses. It just becomes less valid later on. Um, so that'll segue us into the topic that I think Erica picked with probably Darren's direction as far as like hitting those content buckets. But today we're talking about mitigating risk. Um, and she has pulled together a lot of stuff for us here to talk about when it comes to mitigating risk for the property management company, the marketer, the owner, which we'll definitely get to, and then we'll sprinkle in our own experiences with like how we think about mitigating risk at a company because we've obviously not been owners of a property before, therefore we need to weave in some of our own experiences. But where do you
100%.
want to start?
Well, I want to start by saying I think we're going to get a lecture about intros from Darren next time we talk. It's like you should keep doing them, but don't do what you just did.
Yeah.
So I'm just laughing at ourselves. Uh, yeah, we there's a lot of different places to dive in. We could start with, as you said, more our experience as owners and building this company and how we've approached mitigating risk, what kind of, I guess, level of priority or attention we put on that the further we've got into it. Or we can dive dive into our customers, which both sides, like owner operator versus marketer.
Well, as we go,
I'm good either way.
I'm usually framework oriented. So as I think about a framework, I think it's important to acknowledge that different companies are at different stages, like in their life
Right.
cycle, and the way you want to mitigate risk is different.
Hmm.
So Digible, like in the early days, we had very different things. Like we only hired our Courtney that we've had on, our HR director. 6 months ago, maybe 6 months ago.
Yep.
But that was an area where we had ways to handle HR before, but we didn't have a dedicated person there, and we accepted the risk. But as we approached 100 people, we're like, we should start to consider, just someone dedicated that this be their sole focus. So that's one example. But then same would go for like if you're a property management company with 10 properties versus 50 properties and sort of the infrastructure you have to build out. For our listeners that haven't been business owners or in the maybe just on the operation side for too long, I think it's healthy for them to understand why um, things may or may not be a priority at that time. So where I'm going with that is in the many people think if you're a big company that there's efficiencies of scale, and so they're like, oh, totally, like you're going to save money by using that company if you go and hire that management company. But that's not always true, because as you get to certain you know sizes, it sort of triggers a lot more infrastructure you have to invest in. And when it comes to, I'll say, service oriented companies, which I'll consider property management kind of service oriented in its own way, you you just can't cut all the labor costs out no matter how big you get. And in fact, you end up with more layers, more hierarchy, more leadership positions that add cost to the. So, anyways, I just think that that's important to understand that fundamentally, and then you have to think about that as your business and deciding when do you hire HR, when do you hire like a general counsel on staff versus outsourcing and the like.
Yeah, it's a huge part of the equation what you're just describing as far as the size and the impact of growing and how you think about it. It just occurred to me out of all the business books we've read, I mean, certainly there's The Productive Paranoia, which I'm sure we'll touch on a little bit from Jim Collins, that I think is so powerful and valuable. But what it doesn't lay out, and I'm going to go almost Rand Fishkin here, like in his experience as a, I guess that was his first company, right?
Mhm,
The Lost and Founder. But what I really appreciated that is just how personal kind of a memoir of like what it's like to found a company. But I don't recall him hitting this either. So I'm just saying like there isn't it feels like a lot of business books or podcasts devoted to this when you're founding a company, the stages of risk and how to be thinking about them.
mhm,
Because day one, unless you are, I guess, and plenty of people are venture backed and hire 200 people right away, you're not thinking HR, like you
mhm,
said. But you should be thinking about some things up
mhm.
front, about risk. And usually it's going to be more connected to financial. That doesn't necessarily ever go away, but I'm just saying, wouldn't that be valuable? As you mentioned, you think, and so do I. We both do in terms of frameworks, but that you could see like a 3 to 5 year uh, visibility of risk
Mhm,
that you should expect as you grow. In our case, a bootstrap company, because we've done it more, I think, the way most people do, which is, you don't really know it's there until it hits you in the face, and it's
mhm,
like, oh man, we are overdue on bringing
mhm,
in somebody from HR.
mhm,
We've just had 4 employees that have brought up this and this.
mhm.
Why didn't we do this sooner? Versus we had already anticipated or sketched that out. So I just think it's definitely I don't know if it's fair to say a full on blind spot with entrepreneurs as they're building out companies, but yeah,
Well,
unless you have a specialist, that you bring in early as far as almost a consultant, I think it's very reactionary in the way that most founders and entrepreneurs approach mitigating risk.
I love where you're going there. Um, one thing that I think is really interesting that I'm not a huge Dave Ramsey fan, but you know who he is? He's this financial person. He's built up an empire of just like how to give you financial advice, both business owners, but also personal. But anyways, he's famous for saying almost like he's characterized as debt is evil, like basically never have debt. And one of the way he explains debt is his background is financial planning, but also he does have some real estate background. And he said, if you bring in an MBA, so we bring Ryan in. I mean, he got Master's of Finance,
Yeah.
but you get it right. An MBA would be like, okay, if I'm going to buy this stock, I need to factor for risk, or like if you buy the Nasdaq, it's 8% returns or whatever historically. But if I buy this tech index fund, there's going to be more risk there, more volatility because it's tech. Or if I buy this AI index fund, there's more volatility. And an MBA will usually underwrite the risk
Hmm.
against how much volatility. Like, yeah, the tech, usually is at 22% returns a year versus the Nasdaq. However, if you were to like factor out the like actually factor in the risk of the vacillation of that, it may be that the respective risk of Nasdaq is that the respective return is 10% versus the respective return is 8%
Hmm.
on the tech stock. Anyways, what he was saying for real estate is that you people don't typically work in what is the risk factor of if you take a loan, there's some risk with taking a loan and you need to underwrite that. So most people think, oh, I can borrow at X and then I can buy this property and it appreciates at whatever. And so that's my spread. He's like, but you got to factor in the risk of the
Hmm.
loan.
Hmm.
And so I thought that was really interesting. But same thing with the business when you think about like investments. Like I don't know of a to your point, like a consultant or a firm that would come in and help just very easily and economically identify those areas of risk. So my example for us in the early days would have been insurance. Like Digital didn't have business insurance in the beginning because it can be costly. It's also time consuming to set up and yada yada. But at some point, we started bringing on clients where it was a requirement of their vendor agreements that,
Hmm.
hey, vendor, you must supply us with $2 million in coverage, a liability coverage. And so that was a forcing function for us. That is one thing that also keeps these, I'll say, like, two-man shops out of property management, like providing marketing services, because if you're two people, maybe you can't afford to take on that client, then now you got to
Right.
spend 15,000 a year on insurance with. So that is one thing as far as startup costs for moving into multifamily as a vendor that is challenging. And then there are some management companies that we've worked with where they require us to have X millions of dollars of on-site insurance. It's like,
Mhm.
well, we will never step foot on your property. So why do we need this on site? It's like, that's mandatory. You can't get past it. You must have this. It's like, well,
Protocol.
yeah, right. It's like, well, I'm going to buy $5 million. It's going to cost me, X, tens of thousands of dollars. It's like, we just can't, it's just not going to work for us. Like, we'll
Mhm.
be upside down, like
Mhm.
servicing you guys because of this requirement. So there's also the risk, I'd almost say on the other side, right? Like, what are you requiring your vendors to do? And in that case, I get maybe the blanket so you don't have someone that then comes on site and causes a problem. But um, yeah, it's trade-offs.
It is always those trade-offs. Yeah, I think on the vendor side, what we've experienced, and I slash learned is just how much that risk is tried to be passed off, through, the indemnification clauses, liability. So it's like effectively our clients, are de-risking, but they're, as you were saying, like with the insurance coverage, for example, they're passing that cost on to the vendor, versus, and not that they shouldn't. I would do the same thing. It's just not something that I think you or I were anticipating up front as we were building out the company, that we were going to, as we did start working with larger clients, this become a regular thing where it's like, oh, you need to de-risk, working with us,
Hmm.
and now we're going to have to spend some money on that.
Hmm.
So back to just the education, it has definitely been an education, for us, and what that looks like, what it means. And now we're on the cusp of, I think it's fair to say, another level, right, of digital. And you see this like on a personal level, right? The uh, older, uh, I don't want to sound bad, but older people, typically have better insurance. At least those, with financial means, and they just keep beefing that up and beefing
Hmm.
that up.
Hmm.
But often things don't happen, and then you're just like left wondering, yeah, did I overdo
Hmm.
that, or yeah, did I have the right amount? So that's part of what I'm struggling with, is as we're going through these different horizons as a company. How much, effort and cost should we be putting, to this whole thing? Because you often don't see the ROI. It's just peace of mind.
I think it is peace of mind to your point, because if I'm back to that two-person company coming in to serve as a vendor, if I wasn't required to get insurance, I wouldn't get insurance, because at that point it's like, well, just hang another shingle. Like,
Right.
if you get hit with
Right.
something, hang a new shingle, because there's not that much
Hmm.
at risk. Now, Digible with peace of mind, like, I guess you got to look at the whole, like, if there's a 1% chance it could kill Digible, isn't it worth 1% cost or whatever, or half a percent cost or something to do it. So there is something to it, like, but you got to figure out your own formula, I guess, or like directionally, or do you just use gut? Because when you and I talk to different bankers or advisors or whoever, there's some people that are like way skewed on the. I'll even say Courtney. Like, Courtney, when she came in for HR, she has that spreadsheet of like 60 items that she wants to solve. And of these 60 items, it's like, well, what are the chances of that happening? It's like, 1 in 100,000. It's like, yeah, put that on the back burner. Like
Hmm.
like, I
Hmm.
understand it's on your sheet, but like 1 in 100,000, like we'll roll the dice there. Because to
Hmm.
your point, like on all the insurance that we've paid now, there's been zero payback,
Right.
no ROI on that.
Right.
And same with other means, like we've talked about, like, okay, well, do you get your financials audited, or do you um, like um, shoot, there was another investment we were looking at recently. Um, well, even when we got this building, remember how, so this building is a 1920s, like from the 1920s. It was a J.C. Penney that now turned into the digital office. It's a cool J.C. Penney for those that haven't seen it.
Very cool.
But they, when we first got it, they're like, you need to install an elevator. Do you remember this? And
Right.
it's like, why? It's like, well, because what if you hire someone that needs an elevator? It's like, cool, so we'll put in an elevator. Like,
Yeah.
then we don't
Right.
need to put in
Right.
this elevator now and then every year get it recertified,
Hmm.
and the
Hmm.
maintenance on it. It's like, forget it. So we haven't yet put in the elevator, but we know where it will go.
Yeah, we do. Well, I don't know. I mean, we just talked to HappyCo on the last podcast, and one of the things they help with is when you're going through acquisition, like the due diligence and stuff. And certainly there must be some element of risk analysis, if not a heavy element of that, as part of their platform. So something maybe we could come back to Jen Doe, on. But I would imagine there's a lot of what you just described with Courtney when she came and sat down and had that risk registry. I think you're right. It was about 60 items. There's this gradient, and it wasn't formulaic. It was just kind of
Mhm.
directional.
Mhm.
And then it's like, okay, well, Reed, David, Nicole, how do you feel about that one? Oh, 1 in 100,000. We're good. Let's move
Mhm.
on.
Mhm.
Shouldn't there be something better than that, that is, AI driven,
Mhm.
technology? And again, I don't know. This is a great question, maybe for Aaron, who's going to be one of our panelists at the summit, because he is coming from that owner investor side of things that they use, a tool that they use to operate with.
Mhm.
Um, so instead of from one ownership to the next, because I saw that at the Post, the same movie basically, where we'd sit around the table and something would come up, and it's like, well, this could be a risk, to the business, and then it would invariably come back to the CEO and be like, well, what do you think, Mac? And he'd be like, I'm okay with that. It's like, is this really the way
Mhm.
most businesses, not just, multifamily, but most businesses operate? It seems kind of crazy to me. I'd rather have a tool that, you often mention betterment, but on the financial side, just in those portfolios and how you approach risk financially as just a sole investor, um, that there should be some tool like that for probably small, medium businesses, not just one vertical.
Well, maybe we do a live action workshop, if you will, but if you were to try to assign, like, what your, return on covering for risk would be, what do you what would you assign it?
I usually not a loss for words, but I have a hard time answering that. I I mean, is it that it's more a personal thing, back to, like, my own instincts and comfort level? It's like, so how much value do I put on my peace of mind
Right.
so that, I'm not waking up in the middle of the night wondering about a lawsuit or something?
Mhm.
Because that is a great example. It may be 1 in 100,000, that there's a chance that we get sued,
Mhm.
um, but that actually, even with those odds, if I knew that it could break the company,
Mhm.
I'd still invest that 1% you're talking
Mhm.
about. But I see the comparison when you did mention, if I can real quick, coming back to the 1%, like, wouldn't you do it? It's almost like some of the small, like, cost affordable tech that's coming into multifamily, where it's like, hey, just add this to your
Mhm.
properties. It's only $50 a month,
Mhm.
or X per unit.
Mhm.
And it's like, right, but that adds up. And it's the same thing with all these different places you can de-risk. If it came down to just 1% for, the full, like, boat,
Yeah.
I'd be all in like that. But it really is, sometimes feels like a nickel and dime scenario. And then it's harder to, you're back to your question you just asked, to really make a determination on how to ROI that out.
Yeah, let's go on, let's sort of almost like, bookend this. So going in the extreme, if you were czar of the United States and there's a 1%
I
chance
am
that,
czar of the United States.
yeah,
You didn't know that?
if there's a 1% chance of, like, this terrorist group having nuclear weapons or whatever and using it, I feel like you have to move on that 1%, right? Because that is um, even though it seems like a low chance of, or it is respectively a low chance, but massive implications if true. So therefore, you must deploy resources to. But that's almost the whole company ending thing, right? So, and on the other end of the spectrum, if it was like you put $1 in and you get $1 back, at this stage, Digible's probably not going to pay that margin
Hmm.
on, um, on a risk mitigation peace of mind, right?
Hmm. Hmm.
So, maybe, just to almost help frame this, how does that change from startup through, like, established company mode? Meaning, are you looking for a much higher return on investment in the beginning? So, the 100,000, you want 100,000 X return on something in the early stages, or is it actually, almost the reverse? Like, you want the 100,000 return when it's a mature company.
Well, I think in the startup mode, the goal is to survive. And so, from that standpoint, it's not as much a monetary thing. I know you're trying to simplify this, frame it, in that dollar to, dollar return risk. But where I would invest quite a bit, if it significantly enhanced my chance of survival.
Mhm.
because you just run into so many things in your first couple of years, and that's why the numbers are so staggering, like against you of
Mhm.
making it. So there's a million different reasons businesses don't make it, but I assure you, there's plenty of that that involves uh, or could have de-risking that just are not even considered. And so from that standpoint, yeah, I might be more aggressive and expecting, on some level a higher return because it's like, man, if I can get through those first 2 years,
Mhm.
I'm golden,
Mhm.
And then I'm, I guess, more measured, like meaning, not as high of expectations, but I also know now I have, kind of a bigger company, potentially moving to an enterprise. And so I still have high expectations on the ROI, but for a different reason. I don't know if that helps. I mean, in some level, it's kind of like, thinking in terms of lease up versus stabilized, um, but it doesn't totally translate.
I think, right now, the way I'm viewing it is this, company killing or not, right? And that is like, okay, if you're in the early stages and it's company killing, then I mean, even so, to your point, I probably still take way more risk because it's like hang a new shingle, right?
Hmm.
But in the later stages, I'm willing to pay a lower return on investment of that thing happening. That said, I have to pick up more of those things, more of the million to one odds, like things.
Hmm.
It's just what am I willing to pay? If it's a million to one odds, it's happening. But maybe I'm willing to pay like I need a 10x return on my investment to make that happen. It's like, will this happen once in 10 years? Okay, probably. Okay,
Hmm.
let's go ahead and pay for it,
Hmm.
right?
Hmm.
Now as far as the um almost I guess like the company killing or not, my attitude changes a little bit. Like company killing on like an insurance policy, yes, I'll pay for the thing that's a company tech, um, like IP, like in case like our team accidentally violates a patent that they're not aware of, because we were also told don't go investigate all the patents out there because well,
Hmm.
whatever. That's what our IP attorney told us. So we bought IP insurance. Okay, great. That makes sense because that could be company killing. But if there was something else where it's like you might get um, I want to use the elevator example again, but it's like, okay, yeah, no, if we hire somebody, we will then install the elevator and we
Hmm.
won't, like filter anybody because of that need. Um, so we will wait, but that's not company killing. That's just like, okay, we'll probably have to pay more to get this installed in a quick time period versus like, doing it years in advance.
Hmm.
So I think that's, just how I'm starting to frame the risk of how we would invest.
Yeah. Well, your elevator example, you have to look at the layers of risk to that. And I think that, again, is why it takes somebody that's really skilled at it to see, yes, on the surface, like this is something that, like workers' comp, this, somebody could, fall that had a disability that you didn't account for. Um, and then the risk that comes with that, of course, is lawsuit, uh, culture, which is harder to see. I'm just saying a lot of times when you look at different scenarios, there's layers, and I just assume that's part of how you determine how big of a risk something really is. But as you were going through that, I don't know that I'm pivoting here, but it just hit me pretty hard that a lot of what we've been doing related to like the fringe benefits, even starting with the 4-day work week and building this great culture. We know that the front half of Digible's purpose is to be a role model for a culture. Tell me if you see this differently, but isn't in many ways that one of our biggest efforts to de-risk and has been from day one as a startup?
Having a super strong culture.
Yeah, because if you think about it, like if we had, I'm going to use your phrase, rolled the dice and maybe gone more equity, with our compensation, skipped out on insurance, we convinced ourselves, and I know I was, at the front of that, that we really wanted to treat people the right way, do things the right way, and create an amazing culture. But you could also think in terms of, we're de-risking, and this is a great example of us investing so that we don't have the same churn rate. Then you actually can start to put a real ROI to it over the course, of 5 to 10 years, where it's like all that stuff that created this great culture has also dramatically de-risked us from a human capital standpoint.
Hmm.
Because as we were doing that workshop last week, Nick brought up just how you can't overlook that super IC,
Mhm.
and often when you're looking at layers at a company, you don't think as much about that person as you do maybe senior management, for example. And if you're smart, you either have somebody else that has some skills, right? Similar, which is not easy when you have these super ICs, or you just treat them extremely well. And that's tricky because you obviously don't want to overpay either. But I think that's where you start to see this intersection of technology and people when it comes to de-risking, which I think maybe a lot of people before technology really, became so embedded and so expected at companies would take approaches that we're taking. Maybe not a 4-day work week, but it's like, we'll find ways to de-risk, through compensation packages, et cetera. And now people are like, well, now we can actually start using technology more and we're not as reliant on human capital. And that's like, kind of that dystopian future where it's like more and more you don't need to worry about de-risking with human capital
Mhm.
because technology is taking over.
Well, let's divide this up then to internal and external risk and look at that. So internal, I'll say, is kind of what you were saying about churn. So investing in culture. And I think that's an excellent one to start with because it definitely applies to property management as well. Like we've talked about, we've had, I can't even remember how many clients now wanting us to help them place more maintenance people
Yeah, I
because
figured you were
the
going there.
churn.
Yeah.
But sticking on the service
Happy
agency
Co.
services, yeah,
That was for you, Jendo, if you're
yeah.
listening.
Yeah, give it clip that out and send that to Jinto. Um, but on agency services, the last data I looked at was that the average agency services company churns 30% of their staff a year, which is massive churn. And
Almost a third, yeah.
yeah, we have like 5% or less than 5%. We're still, the numbers are challenging because we don't have an easy way to pull it because of adding people, growing our people. And you probably don't want 0% churn because there is something where you definitely need like some turnover and bring new ideas in, as well as like definitely people, they are at different stages of life than maybe the company's at. So I don't know that 5% would be the number we should shoot for, but that's something that Courtney's working on, is deciding what is the accurate number we should be goal orienting. But we're definitely way far away from the 30%.
Mhm,
For me and you, like a couple of years ago, we definitely felt we don't have a recruiter, we don't have an HR person, and we're growing fast, so we can't really afford to lose anybody. So invest all we can to give peace of mind that like if they leave, it must have been for a hell of a reason. But we'll over index for culture. Now we've gotten to a spot where we have HR director, we have a recruiter. It's easier for us to be like, okay, is 5% the right number, or where do we need to be on this scale? Because you also don't want to get almost like held hostage at some point by a key employee. So that would be another external risk would be making sure you have layers of succession so that you don't have anybody that is just your two key person risk. And that comes all the way down to the front line. So you did this even before we launched the company. You always want us to be three deep on every account. You want us to know three people on the customer side and them to know three people on our side so that you mitigate the key
mhm.
person risk.
Yeah, exactly. And, I I'm gonna come back to shouldn't there be some technology or platform, but, what I have seen, and I think you've had some exposure to this, but over my career from different HR leaders is they will show you, the cost of churn.
Hmm.
And they'll say, anytime you lose a person, it's actually, means $75,000,
Hmm.
to that you're cost wise
Hmm.
in order to train, recruit, all that stuff. And so therefore, if you can actually put a pretty confident number on that, then I would love to see something that says, hey, by increasing your compensation, by adding a
Hmm.
4-day work week, it's almost I keep coming to that LinkedIn profile, but where it's like you are now indexing, really heavily on culture. Um, and the good news is that that actually is probably saving you X amount of money
Hmm.
based on the cost to turn employees and what retention at back to your turn of 30% would be versus
Hmm.
5%. And it gets way easier, right? I
Hmm.
mean, it's still hard sometimes to make those big investments, but to know, hey, we may never actually see this, but that's a good thing,
Hmm.
that we're able to hold at 5-10% churn instead of 30.
Yeah, Nicole is interested actually pretty heavy on investing in a platform called Culture Amp that actually helps
Yeah.
you pull out that ROI so that you
Oh,
can,
does it?
yeah, that
Okay.
way it's like, to your point, it's like, I want a 10x return on culture. Great. we are going to invest another 7,000 in an employee to save, you know, the I guess the delta, the 63,000. Um, so the other thing I think that's important that I want to like highlight for the marketer or operator listening, when your whole plan of 3 by 3, it's just as important for them to have that goal. Meaning, like Digible, if we have a vendor that we're working with, we should definitely try to know 3 people on their side, because if our person leaves, like major risk if they replace it with somebody way less efficient or capable or what have you.
100%.
So I'm just saying, for the property management company or marketer, make it a goal of yourselves to know 3 people at Digible or whoever your vendor is, in case you lose your account manager, some changeover, some life event, uncontrollable happens. You have other people that you can go to, and it doesn't feel like you're starting over. Because that definitely has always been a fear for me, for any vendor that we build a very special relationship with. If that key person leaves, I'm like, because I don't know if that's typical that the organization is this good, or if that is like because that person is that good. And so I want to mitigate the risk of, if that person leaves, I know what the rest of the company's like.
Absolutely. Well, take that a step further. Just as you were talking about that, it again brought me back to our podcast with Happy Co. And I asked him how he was going to market. I know you remember this thread, and he said, "Well, there's how I go to market, and then there's how our salespeople go to market." But he said, "How I go to market is I emphasize the fact that Happy Co is in it for the long run." And so as we're talking about like this narrative of de-risking, one of the hardest things for new property management systems, prop tech to do is convince people they're not going to get acquired, within a few years from, some of these giants. And that makes owners really nervous, and understandably so. It's like we are literally putting like our operational technology, like, I mean, it's on the backbones of your system,
Mhm.
and I don't know if you're even gonna be here in a few years.
Yep.
And it's a recurring thing that's happened in this industry, and it probably is part of why it's, moved a little bit slower, is they've seen so many companies gobbled up that it's really hard to believe, "Hey, yeah, I'll put my entire portfolio on this new tech,"
Mhm.
only to find out that, 3 years later, you're gone. And then I have to deal with that mess, because a lot of times these companies that are acquiring do not maintain that technology. They quickly, like, pull it apart, grab a few things they like, and then, shove it into their stack. And so I think it's just a great example. You said vendor, I'm taking, just one step further in this industry. That technology risk of related to acquisition is huge.
Mhm. I think it was Phil, who was previously from Amenify that we had on, that then now is at Colfax Ventures, but he had said it was a big aha moment for him when he learned that any management company can really only take on 2, at max 3 new system rollouts a year.
Mhm.
And so that helps set perspective to say, okay, am I gonna new start, cool ass new startup? You're in your 18 month. You may not be on the market to be purchased, but also you raised money, so you only raised 2 years of capital or something. Like, if
Yeah.
you even know that,
Limited runway, yeah.
right? So then it's like, am I really gonna risk, let's say 50% of my chips this year of like what initiative I can take that you may evaporate in 6 months? Now, your vendor never tells you that. It's always things are rosy or whatever, but you can use some of it to back in. If someone raises money, at max, they raise 24 months of capital. Like, usually it's 18 months of capital. So if they're 12 months in after raising money, they're within 12 months of burning out unless they've raised more
Mhm,
money.
mhm.
So it is a factor that anybody listening can use to say, is it ready to take this risk? Are they ready to? Versus, someone that does have 4 or 5 years in. Now I know you have traction. I'm aware of you in the market, and I'm ready to make you one of my 2 bets this year.
Yeah, totally. Back to the layers of risk, kind of the ripple effect of some of those choices on whether to or not to. But if you do roll the dice and you're trying to turn the corner, be, I'll say, a more innovative company, because that's a stigma, right? A lot of times in this industry is, it lacks innovation. It's very risk averse. So if you're trying to buck that trend and create, more of a forward thinking culture, we'll say, and then that scenario plays out, you're not just risking like the operational, like, you know, uh, side of things. You're also risking the people side, because when those experiments fail, who do you think deals with it? People. And what really still to me is the most important capital you have are people. Still, very much believe that. Hope I don't sound naive saying that, but and if through trying to be more innovative and more risk tolerant, you have too many of those examples where things didn't go your way, didn't work out. You can end up losing people
Mhm,
because they, just yeah, they've nobody loves change and they want a more stable environment.
mhm.
And if they're handling mess after mess because you're getting it wrong, so it's tough. I had some other stuff, and I think you and I probably could make this a 3-part podcast, not just a one or two. That are more specific to the marketer. I'm going to surface them and just see if any one of these you want to latch onto, or if you want to save them all. But our core customer, I mean, I think it's fair to say we really have two, not just one. But I am going to, focus on the marketer here for a second. But the multifamily marketer, I feel like, has several categories of risk. I'm going to start with somebody like us with Digible. You mentioned, and so it's fair to make the connection of vendor, but like with an agency, what are they really at risk of when they choose an agency, and when they choose one agency versus multiple agencies? Because that's obviously one method of de-risking. You see that with the larger companies where it's like we're not okay with one vendor. But then, there's also some things you de-risk by actually choosing one. So, I'm trying to do my
Yeah, let's
my
start there.
raise my pinky to my
Yeah.
lips on thinking that. I'll give you the other buckets though. Personnel for sure. And so, with these smaller marketing teams, just to your point, and I guess we kind of cover that a little bit in the cultural aspect, but how vulnerable they can be, when they lose somebody. So they put a lot of effort. It's like, yeah, this person's going to be a game changer for us, and they're there for 6 months, and they're like, this industry's backwards. I'm gone. And then the strategy itself, how do they de-risk so that they're not, too tethered to one strategy? An easy big example is ILS kind of versus like digital. Um, you know, should you diversify, your marketing strategy in an effort to de-risk, or is it actually smarter to really consolidate? The data side of things is always comes up as far as risk level from a marketer standpoint. How are you using the data? Obviously we built a whole platform around the fair housing. From a performance standpoint, is there ways to de-risk so that, and maybe this ties more to the strategy, that all your eggs aren't in one basket. You have the leasing factor, the variable there, like to de-risk, and a way to make sure that you aren't losing sleep on conversions, right? Where we'll say, yeah, we're bringing good leads, but there's still a problem. So shouldn't you de-risk there and actually put more effort on your, on-site conversions? And then the last one was just technology. These technology stacks that are hitting these marketers. What's the best way to approach that? So each one of these, like I said, we could probably spend 20 minutes on, but any of those hit you harder, like, but in particular, as we kind of wrap this up and maybe like try and excite people about round two.
Yeah, well, I do think we should do a round 2. 'Cause I also wanna get to external risks. We covered a lot of internal, but, not as much in the external. So let's just quickly cover, maybe it's I think the tech stack kind of fits in with the prior theme we were talking about. But if you were testing a new vendor, or even not a new vendor, because to your point, you see folks that have been in business like knock, like they were, I don't know, it was closer, getting close to 10 years by the time they got purchased. So it wasn't a new vendor. They obviously had traction, and then they get gobbled up, and then it feels like they're getting more integrated, so there's less expansion happening, which and you then question, like, are they going to still service these other platforms, or are they just going to be a real page product? So I guess my point on de-risking your tech stack would be, whether it's a new vendor, or a current vendor, or one that's mature, is it a one-way door, or is it a door that you can go through and come back? What's your exit strategy if it doesn't work out? That's how I would de-risk, and just make sure that it's not a one-way door, and that you have it doesn't mean you need like a 50 slide deck to show how you would exit this vendor, but just like, okay, let's see if we're using knock, things are going well. If it doesn't work well, then we've already vetted two other vendors and we liked this other one and we would go to them next. Great. Like you at least know where else you turn versus, never, vetting these other vendors and having nowhere to go. And all of a sudden it doesn't integrate with your platform.
Yeah, 100%. I think that's a great example. For a second, I thought maybe you were going to go to a company like Knock that is trying to solve, the my favorite subject of attribution, multi-touch attribution, or multi-channel, so that you feel like you're de-risking on the guessing if like about what the media strategy should be. But clearly, that's not where you were going. And I agree with what you said. This gets to bullets and cannons on some level, doesn't it? Which is, also Jim Collins. I don't know if he ever really connects that with productive paranoia, but to me, they're serving kind of the same purpose. I think he's focused more on like innovation, the importance of it, but the best way to approach it. But you're also taking kind of or it's a method of de-risking,
Mhm.
those investments so that when you're doing your R&D, there's some sort of controls on it. And I think that's to your point with all this technology. It's like, how do we that two-way, door? Um, if you not only have that kind of figured out, but also are containing these tests, which I think is what most of these companies do. Some of them will, which surprises me, will just go all in, after a demo or something. But more often than not, I think what they'll ask for is that free trial. So now I'm de-risking financially, and then I'm going to put it on 10 properties. So now I'm de-risking because it's not going to blow up my entire like portfolio if this goes poorly. So those are some obvious ones. I don't know if that, well, if that's sufficient. Because you may still not fully appreciate, like, as you're saying, like how to gracefully exit to plan B, just because you have a free trial and have it on 10 properties. It still could be disruptive, is all I'm saying.
Yeah, I think no matter what, you're gonna have a sunk cost, and you have to recognize that for you to progress. It's the whole like friction causes growth.
Mm,
Like for you to continue advancing as an organization, there's gonna be some friction. It's just you gotta, you know, decide how much friction you want at any time in order to elicit the growth.
for sure.
All right. Well, this was good. I'm glad that we have some more meat on the bone because I definitely want to get into some of those other things that you were mentioning about your marketing and de-risking, but then also like external risks such as like legal and market conditions. So this is
Yeah,
good.
and I you know, back to like my loyalty and purist nature, which I actually don't think that I identify with that, but you got me thinking about it with the whole Huberman comment. But with my man Jim Collins, the productive paranoia, I just love that idea. Um, but with people we've talked to, even in some of these interviews that I've had, I know been interviewing for the CTO position, and a few of them have been Collins fans, and they know about that part of the Trinity, and but they said, "How do you define paranoid?" And that is hard, because it's just like bullets and cannons. And Jim Collins acknowledges this. That looks different for Amazon than it does for Digital.
Hmm.
And so paranoid, what was I saying?
Predictive
Productive
paranoia.
paranoia. That's what I meant to latch onto. Looks different for us than it does for other companies. So I think defining that's really important, and it plays a role in this whole thing we're discussing, right?
Yeah. Yeah,
When are you
my
become?
simple solve for this
Mm.
is I sit next to and close to Ryan, our VP of Finance, and Lurch, our COO, and they are my canary in a coal mine. When both of them start turning red, I'm like, all right, it matters enough. Let's do something about it. They start tweaking out. It's like
Yeah.
too much risk. Let's do something.
That's a great tell when they start to blush, if
Yeah,
it's blushing, actually.
yeah.
All right.
All
Well,
right.
good stuff. Yeah.
Yeah. All right. Thanks all. Hope you got something out of it.